Welcome to your Mortgage Insider Update for this week. We start off a pretty positive week after a pretty strong jobs report. As expected, just under 200,000 jobs created. Unemployment rate actually ticked up just slightly. Could that be the beginning of the uptick in unemployment? So often we see this when a recession is coming, but first we're going to take a look at the inverted yield curve, which remains inverted. We've actually talked about this since, about April of 2022. So an inverted yield curve means the 10-year notes, so the government's debt, the 10-year debt, which we often look at to see the kind of the trajectory of longer-term interest rates, those rates are running below the rate of 2-year government notes. So we're going to take a look at that and what has been in the past. The catalyst to officially call a recession is when the unemployment rate actually starts to tick up. This last month we went to 3.8%, still pretty healthy unemployment, but if unemployment continues to creep up over 4% into the 4.5% range by the end of the year, that could be the telltale sign of recession. We just won't know until 6 or 8 months after the fact before they actually announce when a recession began. So let's take a look at the charts. Speaking of the 10-year Treasury, 6 basis points higher today. If we just take a quick look at the 10-year, we did peak back on August the 22nd. Now we've come way down in anticipation of this jobs report that just came out on Friday. Ultimately, the jobs report on Friday of a holiday weekend, we saw the bond market kind of pick back up, and interest rates have started this week off getting back above this Fibonacci retracement level. Still pretty high, over 4.2 up to 4.25% as of today. So let's check out the inverted yield curve. So the 210 spread, like I said, has previously marked a recession. It happened back in 1978. Now you'll notice the gray areas are recessions. Didn't happen until February of 1980, or that's when they officially announced that there was a recession. That inverted yield curve remained for quite a long time, and then again in May of 1981, a pretty lengthy recession resulted. Now this was at a time we've talked about over the past couple years as interest rates have started to kind of move back up. We were at record low interest rates, and now we're at record high interest rates when it comes to the federal funds rate. So the spread here is the 2-year is actually increasing as the Federal Reserve is raising their short-term interest rate. So we can see we have been in an inverted yield curve. First happened in March of 2022 and has been consistently upside down, so to speak, since June of 2022. Now we won't know when recession, if the gray area ever looms over this this current period we're in. We won't know when that started until it's officially announced. This is something that comes out from government statistics, and we won't know this for quite some time. But if you just look into the past, the inverted yield curve happened in 2006. We all remember a pretty hefty recession back then. An inverted yield curve back in 2000, 2001, officially a recession. Even back into the early 90s, back in 1989, late 89 into 1990, and then a recession followed into 1991. So why all the doom and gloom about a recession? Well, it's officially going to take a recession to get the Federal Reserve to back off their extremely tight monetary policy. So until we start to see the signs of a recession, the signs of unemployment rates going up further than we've just seen this last month, it's going to have to pick quite a few steps higher to get the Fed to back off. Our best case scenario right now is that the Federal Reserve will hold tight come here at the end of September, their next meeting, and kick the can down the road till more data comes out. The next Fed meeting wouldn't be until the first week in November. So with that, have a great week. Welcome back from the Labor Day holiday.